It has underappreciated margin levers, stability of in-licensed portfolio, and MR productivity improvement will aid margin. Scale-up of formulations business ex-India and US in recent years is underappreciated. It estimates 16% margin in H2 FY24 and remain conservative even in FY25-26 at 18% and 19%. Next is Anticon CESC. It has a buy call and target is raised to 150 from rupees 93 per share. It says company is undergoing radical changes. It is setting up 3 gigawatt of renewable energy generation plants, and phase-wise contribution will aid rupees 600 crore per gigawatt of EBITDA by FY26.
Thank you, and right on cue, awaiting the opening, and it's going to be another record opening. The Nifty at opening is likely to scale at 21,700 mark, and the first tick is above 21,700, 55 points higher on the Nifty. The sensex straight away has gained close to about 200 points, and this marks the 5th consecutive day of gains for our market, and the bull run the party continues. Mid-caps moving in step. The mid-cap index opens with a gain of 0.4%. Banks are doing well in trade. Some of the big gainers on the index include NTPC, where the management has laid out aggressive capex plans, particularly on renewable energy. So that's up 1%. Steel continues with its rally. Names like Tata Steel, JSW Steel have rallied 8 and 10% respectively in the month of December. So as the dollar index is now hovering around 100.5, we've seen the rally continue in steel names. BPCL is higher in trade. SBI Life has some green in the private sector banks. ICICI Bank is up 0.6%, while HDFC Bank has opened up in the green, but the gains are fairly modest. Still holding on to the up move on the Nifty right now. In terms of the notable losers today, Eicher Motors is corrected, down 0.5%. Bajaj Auto was up 3.5% yesterday. It's corrected a bit, but again, the gains, the losses there are very slim. L&T, Infosys too have open trade in the red. But again, the losers list, the biggest loser is Eicher Motor, and that's only down close to about 0.5%. JSW Steel has picked up some more steam now. JSW Steel is up 1.3%.
Okay, mid-caps actually for the time being are in step with the frontliners. I'll run through some of the stocks and news. KPI Green straight away up about 7% on the bonus issue anticipation, so 7% up there. CESC, we were just listening into the brokerage commentary there. That stock's working well as we start off 3% up on CESC. South Indian Bank is doing a rights issue, raising about 1,700 crores. Stock's up about 2-3%. Sula says they have had the best ever sales at their facility near Nasik, wine tourism as they call it, and the stock is reacting about 2% up on Sula as well. Beyond news flow, let's see what else is standing out in the market this morning. Still getting some of the PSU movers and shakers. For instance, Hindustan Copper, once again, 4.5% on the upside. Hudco had a strong 10% move yesterday. It's following through with another 2.5% this morning. Then you have some of the other names like IRFC, SAIL, PNB, Union Bank, IDBI Bank, Bank of India. Basically, the PSU party is well and truly on. PSU banks and non-banks. Central Enterprises looking very, very good this morning. Manappuram Finance finding some traction early on. There's also 5-Star Finance, by the way. That stock's reacting to positive brokerage commentary. 1-2% up on 5-Star. And Sona BLW, yesterday's big mover, is putting on more momentum this morning. About 2.5% up on Sona BLW. NTPC still retaining that gain, 1.5% up on NTPC. So this is looking good, strong and solid. All the key indices, the Nifty, Sensex, Midcap and the Bank Nifty, right now all of them are sitting with a gain of about 0.3%. So Prashant, that is not bad considering this huge, steroids pack move that we had yesterday. On the back of that, we're getting a decent open.
Yeah, I mean, can it be another trending day, though, is the question. Because yesterday was a trending day. There was no dip, nothing. I mean, I think at one point at about 11:30 or so, the market came to the low point of the day, but there was nothing. I mean, that was around 21,500 or so, and then the market kind of launched higher. And post 3 p.m. yesterday, the move really picked up. Actually, in the last half an hour, the index added, that additional 1%. Additional 100 points actually on the Nifty. So 21,721 is where we read about 1/3% higher in this on this Thursday morning. So looking very, very solid. Vineet Samre is with us, head of equities at DSP Mutual Fund. He's our market master of the day. Vineet, good to have you with us here. Thank you very much as always. Just a quick word, Vineet. I mean, as you're observing things, as you've observed things over the last many years, we find ourselves in a pretty good place, actually, almost too good to be true kind of place, right? You'd kind of be hard-pressed to find, from a corporate and market perspective, hard-pressed to find really stark negatives out there. So how does one approach things? I mean, if you're invested, if you're systematically putting money to work, it's paid off big time. I mean, if you have been investing sporadically, so if jumping into one pocket or that theme or this theme, basically more discretionary in that sense, then it also becomes a point where you need to make a call, what to do. So address that second point first, Vineet.
So I think clearly we all recognize the fact that valuations have reached a high point across the spectrum. I mean, we keep doing analysis of the market and also breaking it down into the sectors. And what we realize versus the last time we spoke, now most of the sectors on a 5-year, on a 10-year, their historical valuation basis, most sectors are trading at a good premium. So, you have now segments, across the segments, you have either rich valuations or frothy valuations. I mean, one has to choose between that. But then how do you deal with this high valuation, considering the fact that, one has to play this whole economic recovery, which one is talking about, the strong macro, which India speaks about. I think the only way to think about is in two formats. One, when one enters the market on the basis of the long-term, bright picture and valuations remaining higher, then definitely one has to stretch their, stay in the market. The longer you stay, I think that will take care, valuations will be taken care by the duration of your stay in the market. That is number one. Number two, I think what we are trying to do is look at across the board two aspects. One is the valuation premium, the other is the business cycles. So because you have most segments trading at rich valuations, we are looking at the business cycles. Wherever the business cycles are at the low, for example, let's say specialty chemical, consumption at the bottom end of the pyramid, these are the segments where the business cycles are at the lows today. Valuations might not have corrected as much, but these valuations, remember, are on low balled earnings. And hence, as and when the cycles mean revert and these segments start performing, I think there will be a scope for relative outperformance. So I think what we are trying to focus on is wherever the business cycles are still giving you comfort in terms of margin of safety. I mean, those are the areas which one should broadly focus on, is the sense.
So you've highlighted two sectors where you believe the business cycle is maybe at the lower end, if not the absolute trough. One is specialty chemicals and the other one is consumption. Any other sectors where you have that comfort that the business cycle is bottoming out?
Yeah, so see, last 2 years, we also saw the pharmaceutical companies not performing well in terms of their overall earnings. And, one of the reasons were extraordinary increases in the raw material prices, extraordinary increases in the cost aspects. So I think those are moderating, and we see that the earnings which have already started recovering, I think those should sustain. And the valuations there also, by the way, have now, earlier it used to be at a discount to the long-term averages, but there also the valuations have, just reached the long-term averages. So one has to be cognizant of the fact, but relatively, I think the sector still seems okay, given the dynamics where it keeps growing at 11-12%, and you have good ROC, which the sector potentially delivers. Likewise, we had been talking about the auto sector overall because of the low cycle since COVID, since 2019 actually. 19 was a peak for the auto sector. And last 2 years, we are seeing recovery across different segments, sub-segments. Passenger vehicle has seen recovery, CV has seen recovery. Two-wheeler is one where the recovery is still not, it has not crossed the previous peak. So, that's one category which maybe we can call it at a cycle which should recover and maybe reach the previous peaks, and hence one could sort of focus on that. So, I think within the consumer basket, one can look at the auto segment, one can look at the more consumer discretionary, the QSRs where the demand has been slow at the moment. So, I think one needs to sort of identify the pockets which have been slow and hence the scope for improvement as the overall recovery, improves their performance as well.
Okay. Vineet, hi, good morning and season's greetings to you. I'm going to go back to that point you made on specialty chemicals, because it is such a complicated class of stocks and companies, right? You need to be, half a chemistry expert, if not a full one, to actually invest properly. So just expand on that. I was reading a report, one of the brokers put out a report saying some of the oleochemicals players, for instance, Galaxy and, Fine Organics, so these guys, they could do better off because there's lesser competition, likely lesser competition from other Asian countries. But within specialty, where would you start nibbling in, looking at ground level business dynamics and the opportunity?
Actually, you're right. The more we look at each companies, we realize that each of the company is actually sector in itself. You'll have companies talking, speaking themselves as specialty chemicals, but they're targeting different subsegments, fluorochemical, and the likes. So I think the only way to sort of deal with some of these businesses that you have to understand each of these business dynamics in detail as a separate industry altogether, and hence one can't club the whole specialty chemical pack into one view. But let me say this: the parameters which we have used to sort of think about these companies is, one, definitely we have an eye on their long-term outlook, and which is actually demonstrated by their capital spends which they have been carrying out over the last 2-3 years. And I think there is a good amount of visible signs that globally people want to actually look at an option diversifying from, let's say, China as a country. So I think these companies have set up capacities. At the same time, it has got actually, unfortunately, clubbed with a global slowdown in the agrochemical space, which is a large, consumer market for them. So I think as the supply chains there recover, these companies will start performing well. So the metrics which we have been using is that companies which have been strong on capital efficiencies, which mean ROC, companies which have spent good amount of capex over the last 2-3 years, I think those should form maybe your choice of companies to look for in the next 3-4 years.
Okay, so you've not identified the separate subsectors per se, like, I don't know, refrigerants or there's agrochemical players, and there are, some of the pharma intermediary chemical companies as well. So you're not looking at it in terms of subsectors. You're looking at it more from the point of, capital deployment and capex and so on and so forth. Is that right?
Yeah, because as you mentioned, we are not chemical specialists, so we have to go by the financial metrics, which gives us those confidence about the business.
Okay, what about IT? Do you have any confidence that IT is close to bottoming out in terms of demand? Because recently the news flow has been negative, whether it's a contract or an MOU cancellation for one of the large players. So what's the demand environment looking like, and when do you think that business cycle will bottom out?
So, see, IT actually overall, the outlook, generally I tend to remain positive on IT sector because it's a massive cash, throwing sector. It gives out good amount of dividend. And I think the sustainability of the growth over long term looks pretty sound and visible for these companies. But I think we have come in a bit of a slow environment right now for the IT space, and on the back of macroeconomic outlook changing starting next year because of the interest fall in the US market, I think the IT has seen of late rally, which to me seems slightly unjustified given the current slowdown which the segment is going through. And maybe we have 2 or 3 quarters where these companies will have to maybe see some bit of challenge as far as the growth is concerned. And beyond that, I think that bottoming out process should take place is my sense. So IT long-term view positive, but I think the near-term one has to be careful with the valuations, especially the fact that the challenge in terms of the growth is going to remain over the next 2 or 3 quarters. It looks like.
We need PSUs. We have to ask you this question, and I think it's the toughest question that everybody's grappling with. You feel scared when you are buying a stock which is already up 200-250%. But if you don't buy it, it goes up another 50% and then you feel silly. So I think, help us out here. What should investors do with PSUs in 2024?
No, so I think the way to assess PSUs maybe is to have high benchmarks for them in terms of the expectation of performance from them. And clearly, the companies which cross those high benchmark are the ones which one can hold, because over a long period of time we have seen PSUs not having created wealth when we look at the long term. But the last 2-3 years there has been a massive change. So we are actually open to look at PSUs where fundamentals are improving. The growth matrix is looking sound. For example, defense companies, the companies within the power value chain. These are the companies where I believe that the environment has become pretty positive. The balance sheets for these companies are also pretty sound and not worrisome. And hence, I think given that some of these space will continue to show good growth, it is reasonable to remain in some of these PSUs, but definitely PSUs which do not give out strong financial metrics, I think one should continue to avoid, or where one feels that the volatility in terms of regulation affecting their business is going to remain high. I mean, those are the ones which one can clearly avoid.
Okay, thank you, Vineet, for joining in. Have a lovely new year, and we look forward to chatting with you in 2024. Let's see. Let's hope 2024 is as charitable as 2023 has been. Thank you very much for joining in. Let's get to a corporate then. Muthoot Finance is on our radar. Now, Q2 was a mixed quarter for the company. While the gold AUM registered a growth, 3% quarter-on-quarter, year-on-year about 20%, but margins witnessed a decline, and the asset quality too was under pressure. To talk about how Q3 FY24 is shaping up, George Alexander Muthoot, MD of Muthoot Finance, is with us on the show. Morning, and thank you very much for joining in. Let me start with the asset quality question. In the last quarter gone by, your asset quality, your NPLs rose quite sharply, I think 20% on a quarter-on-quarter basis. Could you tell us how Q3 has been and what can you guide for Q4?
Yeah, thank you. Good morning. And first of all, Merry Christmas to all of you and a Happy New Year. That's the first part of it. When you talk about the asset quality of a gold loan finance company, as I've always been saying, it doesn't affect the asset quality at all, because it is just technical NPA. Those which have crossed the 12 months, we consider it as a NPA. That is what. All these are 100% or 120% covered by collateral of gold. And it's just that we, as a customer-friendly approach, give more time to the customer instead of auctioning the gold. That is why. So today, the price of gold is also very, very good. If you auction the gold also, we have to return the money to them. And when customers ask for more time, we are more liberal in giving them time. That is why you see this asset quality. We have never lost even 1 rupee because of an NPA in the gold.
But any sale to ARCs that you did in the prior quarter, any such development or any auctioning in Q3?
The sales to the ARC is also to avoid the auctioning. Even many customers requested us for time. We passed on the gold or the ornaments to the ARC. Now ARC can give more time to the borrower to pay. So in effect, what's the impact is, the final impact is that customers get more time to redeem their gold instead of auctioning it. So the ARC also today, as we speak, more than 60% of what we have transferred to the ARC in the last 2 months back is already being taken back by the customers. So all those avoided auctions. So it's mostly a customer-friendly approach. The customer-friendly approach is what is required for a gold loan, because we need customers to come back to us again and again whenever they need a loan. If you auction their gold, they will not see us as a customer-friendly company.
No, fair enough, sir. Just asking, any sale to ARCs in Q3? There was one in September.
No. I don't think it is necessary also. Q3, Q4, I don't think it is necessary.
Okay. Mr. Muthoot, speaking of the customer, I want to come down to the basic brass tacks questions. And that is competition that gold financiers have been facing from banks. That's been the story of 2023, really. Banks getting very aggressive in the gold financing space. What have the last 3 months thrown up? This is the peak of the festive season, and I'm sure, a pretty busy season for you as well. How hot is the competition? And I mean, in your markets, particularly in the South, Have you lost market share to banks?
No, I don't think market share has not gone, but the market has definitely increased. We have not lost any business. Our business is growing, although not by 20-25%. We are growing by 15% year on year, and this year also we will be able to grow by 15%. We have not lost anything, but of course, banks are definitely into this, and they are also giving loans. But mostly, they look at the bigger ticket customers. And we, as a company, we have always been there with the lower ticket customers because of our branch spread. So what we see is, although there is competition, the size of the market, gold loan market is increasing, and competition is there. Definitely, there has been some compression in the yield also, but then we are still able to maintain a very decent NIM in spite of all this, because there are still many customers who come back to us again for good.
Mr. Muthoot, hi, good morning. Prashant here, and season's greetings to you, sir, and to the entire team at Muthoot. Hi, sir, and congratulations, by the way, on the listing of the MFI subsidiary as well, the MFI unit as well. So that's the other new thing. Your stock is also reflecting some optimism that maybe the worst is behind. So in that vein, one of the things that you said last time we spoke, I mean, actually has been a hope for many NBFCs, etc., has been that borrowing costs have kind of peaked out, and things will actually be much better from here. So you said margins, etc., you should be able to maintain. Could you talk to us about where it could be? Could it be in the 10.5 to 11% range for this year? And can we say now confidently that borrowing costs have peaked?
Yeah, I think you're right. We feel that the borrowing cost is actually stabilized. It is not going up any further. The borrowing cost is because we have come out with recently also, we have gone the 2,000 crore NCD, also at very reasonable at the market rates, same as what we did earlier, which is a 2,000 crore NCD private placement. We are again coming up with, public issue of NCDs also. So cost should always remain the same. But as it is talking about margins, yes, the 11%, 12% NIM is not there today. Probably we can always look at a 10% NIM, maybe plus or minus 0.5% is what going forward also we should be able to maintain. I think that's a decent number for a gold loan company with such a lot of competition from the established banks, etc. But having said that, I think now there is definitely an uptick in the lower ticket gold loans, because I think there is some restrictions on lending by all these small ticket loans by NBFCs, etc. So we see from the market sense we get in the last 2 weeks is that there is a uptick in the lower, that means 1 lakh plus or 1 lakh around gold loans, what we see the last 2 weeks. That's the sense I get from the ground, from the field.
Okay, no, that's interesting, and this is because of restrictions in the for NBFCs, etc., in that space, lower ticket size, right? On the unsecured side, etc. What is your average ticket size? And the uptick you're saying is under 1 lakh? Yeah.
No, it's just about 60 to 65.
Sorry, 60 to 65,000.
Yeah, yes.
Okay. So is this meaningful in terms of an uptick, or what is the feedback? Is this?
Because of our branch network, we have around 5,000 branches, and so we have the capacity in the branch to deal with all these small loans also, because they are more sustainable or more sticky customers.
So not maybe this year, where loan growth you said will be about 15%, but can this push overall numbers higher? Say maybe, yeah.
I think going forward, we should be able to do 15 or more in the coming years also. That's the sense we get. And of course, as I was always saying, there's always a fatigue effect to the banks in these things. I'm sure after some time, they will also get better opportunities for bigger lending and leave the space of gold loan more to the NBFC.
So can you help to corroborate, what are the numbers looking like in the last 2 weeks when you have seen that uptick in the lower gold ticket size? What was the average before? How much has it gone up?
I don't think I have any concrete numbers to say now, and I don't think it is correct also. But the sense I get from the market, from the field, from field. We have the branches, branch managers, and regional managers. That the small loans are definitely, people are coming up more with the small loans, because surely, naturally, it should be there also, because the low ticket unsecured loans, especially in the 50,000, 1 lakh category, is almost drying up.
Mr. Muthoot, just to go back, you were talking about cost of funds because of all these regulatory changes. If I heard you correctly, you're saying that the guidance for net interest margins is around 10%. That's a sustainable number. So so we should expect basically around 100 basis points thereabouts decline in margins over what, the next 1 year?
No, I think if there is a decline in, there will be a decline in borrowing cost also, madam, by that time. There will not be a decline in margins. The margins should remain 10 or maybe 0.5 up or 0.5 down.
But sir, you were at 11.5% at the end of the last quarter. Now, if you come down to 10%, that is a decline, right?
No, these are all small loans. Something which I feel it will be there probably by the end of the quarter. It may be, that's what I said, 10.5 or so. There'll always be a plus or minus 5%.
Okay, finally, you gave us a number of 15% on AUM growth. Just leave us with thoughts. I mean, and this is more strategic sort of outlook going ahead. Will you look at growing the non-gold business, which is very small for you right now? I think just 1,400, 1,500 crores. Will you look at growing that business more aggressively as we step into the next fiscal? What's the strategic outlook, given that, competition by banks is here, it's probably here to stay?
Yeah, something which we have also increasingly realizing is that many of the customers who have taken a gold loan have also a personal loan or a home loan or a vehicle loan or a SME loan from other places. So we are trying to fill that gap. So we have had a calibrated growth in the last, we started about 4 or 5 years back, then the COVID came, and now in the last 1.5 years, we have been calibratedly growing the non-gold loan. So I think we should see that also coming up. So I have certainly said in the next 3-4 years, the non-gold loan should, today it's only about 4% or 5%, it should come to about 20%.
Oh, 5% to 20% non-gold loans.
Not 5%, 5% plus the MFI is about 8%.
Okay, so 8% to 20%, that is non-gold, including the MFI loans. Got that. All right, Mr. Muthoot, good chatting with you as always. Once again, wish you a fantastic end to 2023 and an even better 2024. We'll take a break. Thank you so much. We'll take a break on that note. When we come back, we will have Manish Poddar, CFO of GMM Pfaudler, joining in to talk about the company's business outlook as the Patel family has acquired some additional stake in the company.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter-century of excellence.
Welcome back. Market has been holding fairly steady, 85 points higher. Like Prashant says these days, 100 points just happen in a flash. So let's see if the strength lasts through the day as well. The next company on our radar now is GMM Pfaudler. The Patel family will be acquiring additional 1% stake in GMM Pfaudler at around 1,700 rupees per share. The family will now own just over, a little over 25% in the company, becoming the largest shareholder. Manish Poddar, CFO of GMM Pfaudler, is joining in. Manish, hi, season's greetings. Thank you for joining in. Before we start talking about the business, I just want to get this out of the way. Actually, more a question to promoters, but then since we have you here, what is your understanding when you interact with the promoter family? Will they be comfortable at 25%, or perhaps could there be an intent of increasing the stake even from current levels? Just in terms of the structure, shareholding with Pfaudler completely out now, should we expect any more changes in the coming months or not?
I think, so thanks for having me on the show. I think Pfaudler DBG has been part of our business for well over 8-9 years now, with some 51% shareholding, and they have now exited completely. Whereas Patel family were at 24.2%, as you correctly mentioned. They've acquired another additional 1%, so now they hold 25.2%. While DBAG private equity is out, Chris Capital, another private equity, has come in at 10%. Stake has been acquired by them, and rest, of course, is in institutional investors and retailing. So further acquisition on the, obviously that question goes to Tarak and team rather than, to us as management. But yeah, they're absolutely committed. Tarak is the third generation entrepreneur. So of course, that's their, fundamental business that they're happy to run.
So very recently, you all made an acquisition. You all acquired a mixing equipment company called MixPro. The outgo wasn't significant, about $7 million. But what would be the revenue and margin potential or opportunity from this, say in FY25, FY26?
Sure. So Mixel, what we have to see is in a larger perspective. So MixPro in standalone, the Canadian business does something like $7 million equivalent and does a margin of something like 20+% EBITDA margins. But if you see the whole strategy around the Mixel, so we did something like 30 crores of business back then in 2019 or something. Then we acquired the Sudarshan Chemicals MST business, another 30 crores, so 30 plus 30. The India 60 crore business became 150 crores now as we speak. So that's something like $20 million equivalent in India. Then we acquired Mixel in France, which is again another $17 million, having branches in China as well. And now this MixPro has come up. So the whole portfolio now collectively, Mixel portfolio, turns out to be something like $45 million. The strategy behind this is Mixel has the market share of something like $3 billion. So from that perspective, you see, we're just scratching the surface, and with this whole acquisition foray that we have done. The idea of acquiring Mixel was to add into the portfolios like food and beverages, water treatment, biogas, flue gas desulfurization, and all that. So all these technologies are now under our foray. And with these acquisitions, with this technology in our hand, and the manufacturing space that we have already in India, that brings us a great combination. So we can scale up much faster in the mixing portfolio. And we believe that for, in years to come, they should be at something like 25+% CAGR growth on the mixing portfolio itself.
25% CAGR growth in the MixPro portfolio. Mr. Poddar, hi, good morning. I think after the second quarter earnings, you had indicated that the demand environment, I think especially in the GLE segment, remains a little challenging for 3 to 6 months.
Right.
On both chemicals and pharma segments. Could you talk to us about how that is shaped up as we wrap up third quarter? And some numbers would help. I mean, how many orders did you take in Q3? How does that look as compared to Q2 or Q3 the same year the last one?
Sure. So, Prashant, Q2 we ended with 1,700 crores of order backlog, with 450 crores in India and balance in international business. So that turns out to be India having 5 months of shipment for the order backlog, and international business being at something like 8 months. Now, this year more or less is more like a time correction for the chemical capex, if you may call it. Why I say that is because if you see the earlier years, 2019, we were doing something like 400 crores of turnover. Now, last year we did, March 23, we did 1100 crores. On the international business, September 20, when we acquired, Pfaudler business was clocking $175 million business. Now they're almost like $300 million of turnover, with a significant improvement in EBITDA as well. So all in all, the past 4-5 years have been phenomenal run for the whole business. And now this year has been more like a held up sort of a scenario where the excitement is a bit subdued in the international market, out of, as you know, the entire geopolitical scenario, the way it has been developing, has developed over a past 1.5 years, and the energy prices and all that. So there's a capex, deferral, or there's a delay in decision making and all that. That's what's happening on the western part of the world. When you come to China, we have been facing this whole supply, the huge capex that has already been built up. So that's some challenges over there. Fortunately for us, China happens to be just 8-9% of our total business. So and we are holding the fort very firmly over there. So there's no problem over there. Back home in India, I think it's more tactical in nature, because if you see past 6 months, what has happened is, because of the supply glut of certain chemicals supplies, and there's a price correction. So the chemical guys were more, involved in fighting the here and now battle, rather than looking more, on the capex and expansion side. So that's something that they had to gather. We believe another 3 to 6 months, this scenario should change, maybe even maybe Q1 at max, and thereafter, because the discussions are on, the whole cycle is uptick. However, this is more of a comma rather than a full stop over there. And you see on the pharma side, if you may just add, I think for us, pharma is also starting to looking good, because 5-7 years ago, pharma was 60% of our business, 30% was chemical. Now it's exact opposite, with chemical being 60%, pharma being 30%. The pharma API business, API expansion has not happened at that pace in India over past 5-7 years. That is starting to revive, I think. So that's something, another 3 to 6 months, that should also culminate into orders and revenues.
Just to take that point forward, Mr. Pfaudler, and that's showing up in the numbers, right? Because the order intake, like you said, at the end of September, your order backlog was 1,700 crores. It's come down. You were, always tracking above 2,000 crores for the previous couple of quarters, and then it came down. And the intake numbers have been lower. Now, you're saying another 6 months of sluggishness, perhaps, before this turns. What will this then translate into in terms of top-line growth? FY24 and going into FY25, should we be prepared for a flat year or degrowth? What does it mean for top-line?
Sure. So till first half, we have already done 1,850 crores of turnover. So, if you recall, our guidance was 3,700 for FY25. This year, first half itself, we are running at 1,850 crores of turnover. So that would mean that we are more or less on the target within this year itself. So even if we maintain, we should be growing somehow, and we should definitely be growing in FY25. But that is already ahead of the targets or the guidance that we have been given. So from that perspective, I think we are absolutely comfortable from where we are currently.
Okay.
All right. Sorry. So just a number in that sense. Where will you end FY24 at? And margins as well. I think you mentioned between 14 and 15%. Do you maintain that?
Yeah. So 1,850 for H1 and maybe similar number in H2 is something that we can look forward to. So that's something like 36 to 3,800 is somewhere we should be ending this year at. We did 14.5% in India and international both, and culminating into the consolidated numbers. Broadly, we should be in the same range. Maybe a percentage here and there is something that we can look forward to.
Okay.
You'd also given an EBITDA guidance, right? 630 crore by FY25, along with the revenue guidance of 3,700 crore. Will you exceed that too?
So we have done something like 275 crores in H1 already. So that turns out to be maybe, mathematically turns out to be 540 something for H2. I'm absolutely not saying that is the number that we're looking forward to, but that's how the mathematics would operate.
Right.
is something that we are definitely tracking towards. It's a challenging task for, of course, now in the given scenario, there's a lot of cost-cutting reduction happening over there in the organization. There's a lot of initiatives being taken up on the value engineering, value sourcing, cross-selling, and all that. So yeah, all guns blazing. Hopefully, we should definitely be there.
All right, we'll leave it there, sir. Thank you very much for your time. So hopefully recovery from Q1, if not Q2, right?
Absolutely.
Some of these excess capacity issues, they'll take their time to wind down, and maybe demand also starts to look better. Thank you very much for joining us. That's GMM Pfaudler with an outlook on the business. Let's talk about another company now. Sheela Foam is the stock which is in focus. In terms of stock price performance, it's been a bit of an underperformer this year. Second quarter, the last reported numbers that we have was delayed due to delayed festive season. The India revenue in the first half of the FY24 witnessed a decline. But how is the third quarter panned out, and how are things looking from here out? We have Nilesh Mazumdar, Chief Executive Officer of the company, joining us to answer those questions. Nilesh, great to have you with us here. Good morning. Prashant this side. So exactly that. Did Q3 make up for the slack that we saw in Q2? And what does that mean for the full year then?
Good morning, Prashant. And thanks for having me on the show. Yes, as you rightly said, the first half for us was subdued. And as we moved into quarter three, the mattress business has seen a turnaround. The demand for the mattress category during Diwali and post that, as we move into the marriage season, has been comparatively better off. In our portfolio, however, as you know, that we have three different business verticals. We have got the consumer business, we have the technical foam business, and we have the industrial grade. So in this, the consumer side of the business has seen an uptake on demand during the seasons, and as we are now moving into the marriage season, things are looking better off than the first half.
Mr. Mazumdar, can you put some numbers to that, sir? Morning and seasons greetings, Surabhi here. Can you give us some indication, because there was a degrowth in the previous quarter. Now, as you're saying, trends are improving, at least on the consumer business. How much of growth will you pencil in for the full year? Are you expecting it to be a good second half?
Surabhi, yes, we are expecting the second half to be better. You see, if you were to look at historically at this industry, the industry CAGR has been in the region usually of around 1.5 times of GDP. And this year was really, the first half was an aberration. So if the industry comes back to that same level of CAGR, where that is the kind of outlook that we should also have, being the market leader in the category.
So, I was looking at your revenues for the last couple of quarters. In Q2, consolidated revenues were about 631 crore. 7 quarters back, in December of 2021, your revenues were about 880 crore. So we've seen a very sharp decline in your revenues over the last 7 quarters, from 880 crore down to 630 crore. When can you get back? Now, FY24, you're likely to possibly see, contraction in your top line. In H1 itself, revenues are down 10%. Give us some numbers for FY24, FY25. When can you get back to that quarterly run rate of 850, 900 crore?
Yeah, so let me first try and explain some of the reasons for the top line. You see, we had strategically taken a call to stop some of our sales of mattress, which was happening on the e-commerce, which was a deep discount branded sale that was getting created. So we took a conscious call that we must focus on the quality of sales and just not at absolute numbers. So categories where the margin structure was not making sense, or were at unhealthy margin levels, we took a conscious call of staying away or not driving those businesses. So that was the first thing that we did, and therefore that has also impacted the decision that we have taken. For us going forward, as you would know, that one of the biggest events that has happened in Sheela Foam is the acquisition of Kurlon. So now we have got two very strong brands in our portfolio, which is both Sleepwell and Kurlon. And as we speak, we are in the process of creating the strategy for the year FY25 and the 3-year down the line from there onwards. And we are quite excited with the potential that the B2C category has for us. And as I was telling you, that while we have historically, the industry has seen a 1.5 times of GDP CAGR growth. Going forward, we are looking at ways and means of how we can look at driving a growth from a 2-year time frame of 2 times the GDP growth. There is a significant potential that we see in the mattress category. If I were to compare today in India, for example, we sell annually 18 million mattresses in the country. And if I were to look at some other durable category, if I look at, for example, refrigerator in the Indian household, 300 million household, every household requires just one refrigerator, and that category is 13 million. And
Mr. Mazumdar, Mr. Mazumdar, sorry to come in over there. Again, so that it will give us some idea of the numbers that we can work with. Your FY23 top line was around 2,870 odd crores. Now, given all of these different strategies that are playing out, FY24, what will be organic top line? And then you add in Kurlon, because you told us that Kurlon should add 1,000 crores to the top line. So what will be the top line X of Kurlon and with Kurlon?
Yeah, so you are looking at, see, the Indus numbers, which were corrected, is at actually 2,100 crores. And Kurlon, when we acquired the company, was in the region of 850 odd crores. The first objective for Kurlon is that it goes back to the 1,000 crore turnover level. And as far as Sleepwell is concerned, or Sheela Foam is concerned, we should be trying to track at the same growth rate of the industry growth rate. And this is the historical CAGR that I was telling you about.
Got it. All these, it's also a segment which is attracting a lot of competition, right? So when you now go to buy a mattress, there are all these new startups which are very focused on on sleep as a segment. And yes. It was not there, I mean, even before COVID, but over the last couple of years, explosion there in terms of new business. Is that a bit of a challenge or not really?
Not really. You see, most of the new businesses or the new entrants have come in the D2C space, in the e-commerce space, and the e-commerce is currently at about 12 to 15% of the market. The large chunk of the market is still in the physical offline. And even if you look at international markets, e-commerce contributes to maximum of about 15 to 16% of the industry, because this is a category where a consumer would want to touch and feel the product before he or she buys it.
Yeah.
And with the number of players coming in, there is sufficient space in the industry for number of players. So I think the expansion of the market itself gives us a tremendous amount of opportunity in this category.
Take your points. We had a few other questions on on the furniture side, etc. But we'll leave it for another time. But thank you for joining us, and good luck as we look ahead into 2024 FY25. Thank you indeed. That's Sheela Foam with a quick business outlook. We are up about 75 points. 21,731 is where the market is at. So looking good overall. We'll take a quick commercial break here. There's more coming up on the other side.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. 21,700. That's what the screen is telling us right now. There is some profit taking that's setting in, and you can see that on the Nifty chart. Let me look at where that profit taking is happening. Axis Bank down about 0.5%. Bajaj Auto losing some ground. So is Eicher Motors. And then you have Tech Mahindra and Infosys. It's really spread out all over. There's no sectoral trend that we can pick up. But the short point is there's some profit taking at higher levels that is visible. Good time to bring Mitesh back in. Mitesh, so I guess, this is very normal. One would expect that people will digest some of these very, very heady gains. The question is, do you buy the dip? At what point do you get in? What should the approach be now?
I think, good morning. I think buying the dip may not be a bad idea. On the Nifty, I would want to see levels closer to about 21,600. So about 100 points lower is where I think the stop loss should be. Given that kind of a scenario, I think you can explore or venture into long trade closer to about levels of 21,630, 640 zones and take a 50-point stop from there. Similarly, on the Bank Nifty, the big support level which I'm watching is I think 48,000, 48,050 zones. So an entry could be done closer to about 48,200 with a stop below 47,950. So I think yes, buying on dips is a good idea if you're trading the index in the short term.
Okay. All right, Mitesh, we'll leave it there. Thanks. Okay, I don't know if you have any trades specifically, Mitesh?
Yeah. On the stock side, Prashant, Steel Authority is a buy with a stop at 116 for targets of 124. And SBI Life is a buy as well. Keep a stop below 1420. Look for targets of around 1475.
Hindustan Copper, did you have a trade going already, Mitesh? Big move.
We had a trade at 160 odd levels, Prashant, booked out around 180, 185, and the stock hasn't stopped since then. So more of a regret, I think, the way the stock is at it, and I think still looks good to me. If somebody has the positions, Trillium stopped about 236, and let's hope if it can test 290 here.
Wow. A long way to go. I mean, of course, when I say long way to go, I mean, from the highs were in the 650, 700 zone. This, of course, back in 2010 or so, 2009, 2010, at about 252 right now. Mitesh, thank you very much. We'll come back to you for more later. But commodities in focus. Manisha is standing by with what's top of mind. Manisha, morning.
Morning, Prashant. Thank you for that. Most of the agri commodities, and that's what I'm focusing on right now, have seen a profit taking, and they've come off their 2023 highs. So the inflation concerns clearly have been easing. But I'm talking about those agriculture commodities which are still closing 2023 on a positive note. So within that, the industrial commodity clearly is rubber, where the prices are trading at a 2-month highs. We are 16% up for 2023 right now. It is about interest rate easing, and that continues to support many of these other asset classes, including industrial commodities. And within that, the agri interest also has been on the supportive side. Apart from that, the Chinese demand also seems to be improving, especially from the auto, and apart from that, the rubber industry also seems to be doing well. And then there are EU regulations linked to deforestation, and many agri commodities really seem to be getting some premium because of that as well, and that has led to supportive gains there. The other one on my chart is coffee prices up 16 or rather 18% in 2023. Here as well, we are looking at lower production concerns coming into the market. There is limited supply, dry weather in Brazil. And also when you look at the production and ending stocks for 23-24, both of these numbers have been revised on the lower side. Production now expected at around 171.4 million bags. And the ending stock also is at a multi-year lows of around 26.5 million bags. That has continued to support coffee prices throughout 2023, with expectation that 24 could be a positive year as well. Cocoa is the next one on my list, 63% of gains in 2023. That is because, one, the production has been weaker in the major producing countries like Ghana and Ivory Coast, and the demand for cocoa and chocolate across the world has been increasing. Whether it's about US, Europe or Asia, we've seen numbers quite strong, and that has kept the coffee prices in flavor. The last on my list is sugar, and we did see a 15-year highs onto this one. But from those kind of levels, there has been a big profit taking in the month of December itself. For the year, we are up 2%, but in the last 1 month itself, we've seen nearly a 24% of a decline coming in for sugar, with most analysts suggesting that the immediate rally in sugar is done. And for 24, you could be looking at consolidation going on.
Thank you very much for that. You know, you were talking about copper. There is an article in one of the pink papers today titled, "So is copper the new lithium?" I know this has come back, you know, before, and it goes on to say that copper doesn't usually attract the same kind of buzz, excitement as these new age commodities like, you know, lithium and cobalt, etc. But its importance now, for example, that article goes on to say, on an average, an EV requires 83 kilograms of copper compared to 23 kgs, which is required in a conventional vehicle. And plus add to that this entire renewable energy hunger. So I think that's just, you know, fueling the excitement.
No, it's been called this almost like a super cycle for copper because of the transition to renewables. I mean, you know, the, building out grids, etc. Apart from, of course,
and you know, there is a McKinsey report which suggests that the copper market will be in a deficit of 6.5 million tons in 2031 as the demand will outstrip supply. So even there is
31 is a
well,
anyway, but yeah, absolutely. I mean, you know, demand conditions look pretty good, but that's where we're at. Market, by the way, I think dipped a little bit. We were up about 45-50 points. We're up back about 70 points. So very small dips also getting bought into quickly. Stocks on the move. Vivek highlighted JSW Steel in top 10. Let's revisit this with him once again. Vivek, hi, morning.
Well, absolutely. You know, we highlighted this in the morning. Very, very strong commentary coming in from the management, both in terms of demand that they anticipate and also the kind of capex that they have lined up, and also their own capacity expansion plans. Just to highlight that once more, steel demand in 2023 is expected to grow almost 15% for FY24 as well. Company's plan entails an additional capex of over 1 lakh crore, and along with that, they're planning to take capacities up to 50 million tons by the end of this particular decade itself. India's present steel capacity is close to 170 million tons. They're looking to take it up to 300 million tons. So on the back of that, you know, the increased capex is justified, they believe, on the back of very strong demand trends that they're witnessing on ground. Along with that, you know, they want to ensure that India has sufficient steel reserves so that they do not have to import steel, especially from China. They are saying potential exists for #1 downstream capacities to be established in consuming countries as well. They've also alluded to a few M&A opportunities, haven't given any timelines or, you know, identified targets as of now. But, you know, very strong commentary coming in terms of capex.
All right, Vivek, thanks very much for that. Stocks flattish, I mean, 0.25% higher. Canada Bank is the other one we are tracking. Abhishek has got Mori standing by. Abhishek.
Well, Canada Bank, the board has approved, you know, the initiation process with respect to listing their AMC arm, that is Can Robeco AMC via IPO. So Canada Bank holds about 51% stake over there, while the 49% stake is held by Robeco Group NV, which is now called Orix Corporation Japan. So Canada Robeco AMC, the net profits were around 79 crore as of FY23, and they have an AUM of about 78,400 crore. Now, in AMC business, the valuation depends on how much is the percentage of equity in the overall AUM. The higher the equity proportion, the better the valuation. The lower the equity proportion, the lower the valuation multiple is given. So for Can Robeco, the you know, equity percentage as per sources is around 88 to 90%. So it would be interesting to see how this one gets valued versus the listed peers. Back to you.
Okay, thank you very much for that, you know, Abhishek. Here's what we do. We will slip into a very short break. On the other side, we'll be joined by Anil Gupta of ICRA and Sanjay Agarwal of Care Ratings to discuss RBI's regulatory measures towards consumer credit and bank credit to NBFCs.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, you've been seeing those flashes at the bottom of the screen, and they're coming in from the SBI banking conclave that's been underway in Mumbai. And very pertinent. I mean, this is an issue, a topic that we plan to discuss with our next set of guests. Right now, the RBI Deputy Governor is saying that bank loans to NBFCs have been growing at 30% for the past 2-3 years, and hence the fear of interconnectedness. And the Deputy Governor is saying that we're worried that every NBFC borrows from 40 to 50 different banks. Would not like to prescribe an upper limit to the number of lenders, but want banks to come forward with a solution. And I think this is what the last couple of months have thrown up, more regulatory measures from the central bank to ensure that the system doesn't become vulnerable to any sort of excesses, be it on the lending to NBFCs or simply lending to the unsecured sector, the tightening of regulations on the unsecured side that we've seen. Anil Gupta, Senior Vice President and Co-Group Head Financial Sector Ratings at ICRA, as well as Sanjay Agrawal, Senior Director and Head of BFSI at CARE, is with us now. Gentlemen, thank you very much. Season's greetings to both of you. Great to have you on this chat. So let's really open with this. Sanjay, if we could get your thoughts in on the slew of measures and the commentary that we've seen from the Reserve Bank in the last few months in order to ensure that there are no excesses that get built up on the personal loan, the unsecured, the credit card side. Just your thoughts and whether you would expect more of this as we step into 2024.
Yeah, thank you, CNBC, for having me on the show. And in terms of the RBI moves to strengthen the sector, they've been slightly more proactive than reactive or than any situation on ground which warrants that. So if you see the credit growth, especially of the banking sector in the last 12 to 24 months, the average growth to the unsecured loans or average growth to the NBFC sector has been something in the north of 25% plus, whereas the rest of the banking sector has been growing at something around 12 to 13%. So these two sectors have been growing at more than double the speed of the other rest of the sectors combined. There is some reason to it in the sense that NBFCs form the large corporate exposures, whereas the rest of the corporate exposure is not increasing substantially. So to that extent, NBFCs get a leg up. And the unsecured personal loan sector has been getting a leg up due to a slew of measures governments have been taking over the past few years in terms of digitalization, the actuation of the credit information bureaus, and the India stack, and all those things. And the customers have in terms of, let's say, the mobile apps and the ready availability of credit. And these are enabling the unsecured credit space. So in both these spaces have got a huge leg up in the last 24 months. So the regulator is slightly being more cautious, asking the system to keep in more capital and be more judicious in terms of exposure to these sectors.
Anil, have you done any analysis of the extent of slowdown in to the unsecured lending? We've already heard from the likes of Paytm, where they're cutting back on low-ticket postpaid or low-ticket loans. So in the last, ever since the RBI has introduced these measures to clamp down on unsecured retail lending, have you done any analysis of the extent of slowdown?
Sure. So these segments, like we expect that the bank rate growth could actually be shaved off by maybe around 50 to 100 basis point because of these measures. So let's say if we look at the December credit growth, the credit growth incrementally has been close to 15 trillion till December 1st, which is 16.5% YOY growth. But for the fourth quarter, we expect that this will slow down on an incremental basis, and the full year credit growth will be closer to maybe around 18 lakh crores or a 12 or a closer to maybe a 13% kind of a number. In absence of these measures, I think the credit growth could have been higher by around 14% for the banking system. But yes, this will have a slowdown impact. Similar to banks, maybe non-banks also, we have been seeing that the retail NBFC AUMs have been growing upwards of maybe 25% in terms of YOY growth. And this also we expect because of maybe the funding constraints or slowdown in the funding from the banks. This growth can also get moderated to by maybe to around 18 to 20% by financial year 24.
Gentlemen, good morning. We actually just had the management of Muthoot Finance, half an hour back, and they said that under 50,000 rupee loans, he used the word, has completely dried up. So they are seeing a lot of uptick because people want to take out gold loans, which is also smaller ticket size and it's easy in that sense. So yeah, I mean, the impact is being felt. Sanjay, you want to come in? Are you already seeing it on the ground, as Mr. Muthoot told us?
Yeah, so what's happening is when you look at the unsecured lending space, it ranges from upwards of 3 to 5 lakhs, which is the domain of largely PSU banks and large private sector banks, to something which has come in very recently of 2, 5, 10,000 rupees, which is being led again by a lot of activities on the ground and by the buzz on the fintechs. Over the last 3 to 4 quarters, we have been discussing with various players, and they have been providing caution in terms of this set of borrowers. Because the issue is that if you lend 5 to 10 or 20,000 rupees, then you can't put in a collection force or the collection mechanism. So as soon as there's overdue, then the loans have to be written off. And that category had increased very substantially. So that is something the regulators had been telling the market that you slow down on that. And the players themselves are now wanting to go in for much more, let's say, cohesive sort of unsecured personal loans where they can put in the collection agencies and where they can do a better credit assessment. So the common buzz being used in the market is, let's look at a duration risk rather than the credit risk. So the short-term personal loans of say 2, 5, 10 up to say 50,000 is something that the players are not very keen on taking ahead. So the approval rates there have gone down very substantially. And we expect that that category will get hit. And the other side is the NBFCs, which specialize on those loans. They themselves have now started facing problems from the lenders, etc. So it's a multiple thing which is building up. It was building up for 3 quarters, and now the regulator action has been very decisive on that.
Okay, Anil, a two-part question. First and foremost, for NBFCs, are you expecting any sort of a further squeeze in terms of availability of credit or maybe margins, because credit might be available but at much higher cost? Are you expecting that to play out at all in 2024? That's a question on NBFCs. And then on the other side, the unsecured side, is there any risk of delinquencies? Are your models throwing up anything that we should be aware of? Any red flags on asset quality on unsecured?
Sure. So the first question on the funding constraints, we have seen that banks do account for a major chunk of the, let's say, borrowings which the NBFCs do. And this has actually increased maybe in last 2-3 years. Prior to that, it was maybe closer to around 40%. So yes, if the NBFCs have to basically continue the growth, maybe they have to approach more of maybe debt capital markets, but debt capital markets may not be accessible to all kind of maybe NBFCs in a scalable format. So let's say it's largely a AAA and a AA plus kind of or at best maybe a AA sort of a market where you can get a scalable or a sizable funding from the debt market. You have issuances which happen maybe lower rating categories, but you won't get a very large ticket size, and the investors are largely restricted to maybe smaller, maybe HNIs or kind of maybe family offices or maybe some kind of a retail investors. So yes, these measures will have an impact in terms of funding squeeze, increase in risk weight for NBFC lending by banks. Now we are having a situation where possibly the liquidity is tight, and during last 2 years, when liquidity was surplus, giving out credit to NBFCs was relatively much easier in terms of maybe deploying that surplus liquidity. Now, as we are getting into tighter liquidity environment, possibly banks will also reconsider their lending decisions to NBFC, because their ability to per se jack up the rates, that is what we have to see, whether they're able to jack up the rates because of the risk weights. Till now, we have not been able to see a material maybe increase. Their negotiations are still being going on, but definitely with increased funding cost, reduced availability or appetite of the banks to lend to NBFCs, we should see some squeeze or tightness in the funding from the banks, and debt capital market, as I told, is not accessible to everyone. So this will spill over into maybe some sort of a growth constraints for the non-banks in the coming maybe quarters and years. Your second question on the delinquencies on the unsecured loans, the behavioral trend, let's say when we look at the delinquencies, that remains good. So as such, no spikes maybe in terms of delinquencies we would have seen across maybe a wider set of players. But again, we have to see this maybe over some period of time, because these loans, digital personal loans, are something which have been a phenomena for last maybe couple of years. And how these loans play out all through the cycle is something which we have to see. Because today, the access of the credit has eased significantly because of these digital lending and apps availability. So really, just to see how much the borrower is leveraging himself to, let's say, borrow from one lender to repay, that is not clear. So the impact of this tightening possibly will be visible on the asset quality of the lenders, I think, in the coming quarters, when possibly the flow rate slows down in this unsecured loan sector.
Gentlemen, great to get that perspective from both of you. Thank you very much for joining us. It's a pleasure, Sanjay and Anil. And thanks for coming on here on CNBC-TV18. Have a great New Year's. I mean, we're almost there. And of course, all the best of luck for 2024. From all of us here, it's goodbye on this edition of Bazaar. Thank you very much for staying with us. But Chartbusters will pick up on all the action in just a bit from now. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
The Indian market opens at a record high. The Nifty rallies above 21,700, led by a surge in the banks, with the Nifty banking index too hitting record levels. Mid-caps saw marginal underperformance but still holding well in the green.
Canara Bank rises nearly 2.5% as the board approves to initiate the process of listing its mutual fund subsidiary Canara Robeco AMC.
Jayant Acharya, MD and CEO of JSW Steel, guides for strong growth momentum in India. Speaking at the SBI conclave, he says the company plans to take capacity up to 50 million tons by the end of this decade. Stock up nearly 1%.
Hindustan Copper rises nearly 9% as the stock comes out of the FNO ban. The stock has surged nearly 50% in December, making it its best month since the February of 2021.
And a slew of listings continue on D Street as well. Today we have Azad Engineering making a strong debut on D Street, listing at a premium of 35% to its issue price. You don't go anywhere. In fact, management will be joining us shortly to discuss their post-listing plans here on Chartbusters.
Hello and welcome. You're watching Chartbusters here on CNBC-TV18. I'm Hormus Patakia. With me is Mangalam Malu, and it's a fantastic day. As always, we are continuing with where we left off yesterday. We are slightly off the day's high, around 50 points off the day's high, but well above the 21,700 mark. We are fighting to hold those levels, and we are up for the 5th straight day today. And what a December series this has been, Mangalam. Almost 1,500 points this series, the best series of the year. The star performer of that undoubtedly has been HDFC Bank. And that stock, the index heavyweight, top contributor to the Nifty rally this month, is up 12% this month, and it is the biggest catalyst to what the Nifty has moved this month. It's up 0.8% today, 1716 on HDFC Bank, and it is trading close to its record high now of 1789.
Well, when the elephant dances, you know that everyone else around